Something happened in 2008 that shook the world and caused a recession so severe that brought U.S. economy to standstill. Stock markets crashed globally. Millions of people lost their jobs. Many banks and financial institutions went bankrupt, and it cost U.S. government around $1.5 trillion to save the economy from collapse. So, let's see how the story of 2008 financial crisis unfolded. It started with collapse of American housing market and turned into worst economic crisis since the Great Depression of 1929. Thus, it is also known as Subprime Mortgage Crisis, or the Great Recession. The story began in 2001, when U.S. Central Bank Federal Reserve started a series of interest rate cuts. Recent events like dot-com bubble crash, 9/11 World Trade Center terrorist attack, and several corporate scandals like Enron scandal pushed U.S. economy to the brink of recession. In order to provide stimulus to the economy, Federal Reserve did 11 rate cuts in the year of 2001, which brought interest rates down from 6.5% to 1.75%, which further came down to 1% by June 2003. This enabled the banks to give loans at lower interest rates, and even to subprime customers. Subprime customers are those who have lower ability to service the debt and a lower credit score, which makes them high-risk borrowers. Thus, subprime customers have to pay higher interest rate on loans. As a result of lower rates, it got easier to extend credit to them. Subprime lending became possible due to banking law changes in 1980s, which allowed banks to lend money to subprime customers even at adjustable interest rates. Under adjustable structure, interest rates keep changing according to changes in federal funds rate, which is controlled by Federal Reserve. This kind of interest rate structure may cause problems for borrowers if the interest rates start rising. Taking advantage of the cheap credit available, consumers started buying appliances, cars, and especially houses, which led to creation of housing bubble. Subprime loans were fueled by the widespread practice of securitization. Investment banks put together thousands of subprime mortgage loans sourced from lenders and started selling them as securities to investors such as hedge funds and pension funds. This practice was popularly referred to as securitization food chain, and the securities were known as Mortgage Backed Securities, or MBS. MBS investors were entitled to the share of principal and interest paid by the borrowers of mortgage loans, which gave them better returns compared to the U.S. government bonds and made their portfolios appear diversified. Also, these securities were highly rated by the credit rating agencies, erasing all concerns regarding their safety. This made mortgage-backed securities very popular among investors, and it resulted in high demand of mortgage loans. But there are only so many prime customers. As a result, subprime loans started rising. Lenders were happy with the securitization as they were able to transfer their risky loans to investment banks almost instantly. With the money received, they could give out more loans, leading to growth of their loan portfolio and profits. If borrowers defaulted on the mortgage loan, lenders would sell their property, thereby recovering the loan along with earning sizable profit, as the home prices were invariably higher than the loan amount, encouraging lenders to aggressively start giving subprime adjustable rate loans. As a result, the market share of subprime loans increased significantly from 2.5% in 1990s to around 15% in 2007, which was a very high number. Rising mortgage loans led to rapid increase in housing prices well beyond their intrinsic value, resulting in a housing bubble. The reason behind this is deregulation. In 1999, U.S. Congress passed Financial Services Modernization Act, also known as Gramm-Leach-Bliley Act, which partially repealed Glass-Steagall Act 1933, paving way for merger of banks, securities firms, and insurance companies, resulting in formation of giant financial services conglomerates. These giant firms were often referred as too big to fail. The act also allowed to invest bank deposits in derivatives like mortgage-backed securities, which increased their demand. The very next year, Commodity Futures Modernization Act 2000 was passed, which exempted derivatives from government regulation. Along with this, U.S. capital market regulator, Securities and Exchange Commission weakened net capital requirement for banks, which fueled the investments in derivatives even more. There were two derivative instruments which became very popular and caused most damage. They were often referred as the weapons of mass destruction. First is collateralized debt obligation, popularly known as a CDO. A CDO is similar to an MBS. The only difference is that CDOs are broader in scope, consisting of car loans, student loans, credit card debt, along with mortgage loans. Second is a credit default swap or CDS. A CDS is much like an insurance which pays off in case of a detrimental impact on the insured entity. The major difference between the two is that an insurance can only be bought by someone who has an insurable interest, whereas anyone can buy a CDS on anything. Insurable interest can be understood by an example of a fire insurance on a home. Only the homeowner has insurable interest to buy a fire insurance on his home, as his interest lies in protecting it. But if someone else buys a fire insurance, he would be benefited by burning of the house as he will receive the insurance amount. That's a CDS. On one hand, investment banks were selling CDOs to investors as a safe investment option, at the same time also buying credit default swaps on the same CDOs, essentially betting that they would fail. This posed a serious conflict of interest, which harmed the investors and ultimately the global economy. This was a ticking time bomb, and the countdown began in 2004, when the Fed started increasing interest rates. That's it for this video. We'll continue the story in the next part. I hope you liked the story. Hit the like button and share the video. If you want to watch such interesting finance stories, subscribe to my channel and press the bell icon to get notifications. If you want to watch video on any particular topic, please let me know in the comments. Thank you all for watching. See you in the next video.